Options. Every life insurance policy lists a variety of ways the death benefit can be paid, or settled, upon the insured's death. These settlement options give policy owners and beneficiaries considerable flexibility in how the death benefits are distributed. As a right of policy ownership, policy owners can choose which settlement option is used upon the insured's death. Alternatively, the owner can let the beneficiary make that decision upon the insured's death. The common theme behind every settlement option is that the policy's death benefit is spread out into the future. Exactly how and for how long is what differentiates one option from another. Settlement options can be split into two basic categories, those with a life contingency and those without. Settlement options without a life contingency. A settlement option without a life contingency is one whose payment is not determined by the life of the person receiving the income payment. In this category, there are four settlement options. Lump sum cash payment. Interest-only payments. Proceeds are retained by the insurer. Equal payments for a fixed period. Payment amount depends on payment period. Equal payments of a fixed amount. Payment period depends on payment amount. Lump sum cash payment. Under the lump sum cash payment method, the full death benefit is distributed to the beneficiary in the form of a single payment upon the insured's death. Lump sum payments are generally income tax-free. Upon a lump sum cash payment, the insurer has fulfilled its responsibilities under the policy. Retained asset account. In place of a lump sum payment, many life insurance companies will set up a retained asset account, also called a beneficiary access account, for beneficiaries who want to control when policy proceeds are distributed. Beneficiaries receive a checkbook they can use to draw down funds from the interest-bearing account. There are no restrictions on the use of this money. Interest only. With the interest-only option, the insurer holds the policy proceeds in an interest-bearing account until a future date selected by the beneficiary, or the policy owner, at which point they are paid out, either in a lump sum or under another settlement option. Until then, the insurer distributes just the interest, most commonly in monthly or annual payments. The interest rate used with this option is the higher of a current rate or the guaranteed rate specified in the policy. While life insurance death benefits are generally income tax-free, interest earned on funds retained by the insurer are taxable in the year earned. This applies to all settlement options other than the lump sum cash payment option, which doesn't involve accrued interest. Fixed period. Under the fixed period option, the death benefit is paid in equal installments over a period selected by the beneficiary or policy owner. Payments consist partly of death benefit proceeds and partly of taxable interest earned on the undistributed funds remaining with the insurer. The length of the period determines the payment amount. The longer the payment period, the smaller the payment amount. Payments can be made monthly, quarterly, semi-annually, or annually. If the beneficiary dies before the end of the selected period, payments continue to the contingent beneficiary until the end of the period. The contingent payee can choose to receive a lump sum equivalent of the remaining payments. Fixed amount. Like the fixed period option, the fixed amount settlement option distributes the death benefit plus interest through a series of payments to the beneficiary. With this option, the policy owner or beneficiary designates the payment amount, which then determines the length of time payments will be made. The larger the payment amount, the shorter the payment period. Settlement options with a life contingency. In contrast to a settlement option without a life contingency, a settlement option with a life contingency is based on the beneficiary's life expectancy. For that reason, these are also known as life income settlement options. With life income settlement options, the insurer converts the death benefit to an immediate annuity on the beneficiary's life. The payment amount is based on the beneficiary's life expectancy. Longer life expectancies, younger beneficiaries, yield smaller payments. Shorter life expectancies, older beneficiaries, yield larger payments. There are 4 common lifetime income options, each of which represents a common type of immediate annuity. Straight life income. Life income with period certain. Life income with refund. Joint and survivor life income. Straight life income. The straight life income settlement option is the least complicated of the life income settlement options. Here, payments last the beneficiary's entire life, and cease at the beneficiary's death. Of all the various types of life income options, the straight life option generally provides the largest payment amount to the payee. That is because payments cease when the payee dies, no matter how soon that may be after payments have begun. The absence of payment guarantees translates into a higher payment amount. Beneficiaries who are concerned by the lack of payment period guarantee may prefer one of the following options, which include payment guarantees. Life income with period certain. Under the life income with period certain option, beneficiaries receive benefit payments for life with the guarantee that payments will be made to a contingent beneficiary for a specified term should they die before then. Common term certain periods are 5, 10, and 20 years, though beneficiaries may request almost any term within limits set by the insurer. Life income with refund. Like other life income settlement options, the life income with refund option provides income payments for the life of the beneficiary. In this case, if the beneficiary dies before receiving payments equal to the annuity purchase amount, the remainder is paid to a contingent payee in the form of a refund. Refunds are available under either of two options, chosen by the contingent payee. Installment refund option. Cash refund option. Under the installment refund option, income payments continue to a contingent payee in the same amount as were paid to the primary beneficiary. They continue until total payments made equal the amount placed under the settlement option. Under the cash refund option, the contingent payee receives a lump sum payment of any remaining balance. Example: Lydia is the beneficiary of her husband's $150,000 life insurance policy. At his death, she decides to take the death benefit in the form of a life income settlement option. She has the following alternatives to choose from. Straight life income settlement option. Lydia would receive payments of about $800 a month, or $9,600 a year. Payments will continue for as long as she lives and will cease at her death however soon that may be after they begin. Life income with 10-year certain option. Lydia would receive payments of about $740 a month, or $8,800 a year. Payments will continue for as long as she lives but are guaranteed to be paid for a minimum of 10 years. If Lydia dies within the first 10 years, payments continue to the contingent beneficiary for the remainder of the 10-year term. Life income with refund settlement option. Lydia would receive payments of about $730 a month, or $8,760 a year, which will continue for as long as she lives. If she dies within about 17 years, when the sum of payments equals $150,000, the remaining unpaid balance will be refunded to the contingent beneficiary, either as a lump sum or through continued periodic payments. Joint-in survivor life income. The joint-in survivor, J&S, life income settlement option is most suitable when there are two primary beneficiaries related in some way to each other, for example, the insured's son and his wife, or two adult siblings. Under the J&S option, monthly payments are made until the second of the two beneficiaries dies. The most common joint-in survivor options are joint-in 100% survivor, in which the payment continues unreduced upon the first payee's death. Joint-in 2/3 survivor, in which payments are reduced by 1/3 upon the first payee's death, with 2/3 continuing to the survivor. Joint-in 1/2 survivor, in which payments are reduced by 1/2 upon the first payee's death. Example: under the joint-in survivor life income option, a $200,000 death benefit might present the following options to a couple. Joint-in 100% survivor, $1,000 per month to joint payees and $1,000 per month to surviving payee. Joint-in 2/3 survivor, $1,200 per month to joint payees and $800 per month to surviving payee. Joint-in 1/2 survivor, $1,300 per month to joint payees and $650 per month to surviving payee. Joint-in survivor with period certain. For those who want added assurance of guaranteed payments, it is possible to set up a joint-in survivor settlement option that includes a period certain guarantee. For your review, Settlement options can be split into two basic categories, those with and without a life contingency. There are four options without a life contingency: cash, interest only, principal paid later, fixed period, and fixed amount. Under a fixed period settlement option, the death benefit is paid in equal installments over a period selected by the beneficiary or policy owner. With the fixed amount settlement option, the larger the periodic payment amount, the shorter the payout period. There are four common options with a life contingency: straight life, no payment guarantees, life income with period certain, life income with refund, and joint and survivor. Life income settlement options share a common element: they involve income payments that the payee cannot outlive. Of all the various types of life income options, the straight life option generally provides the largest payment amount to the payee. Under the J&S option, monthly payments are made until the second payee, survivor, dies. Please pause the audio and watch the video. You can restart the audio.
Anytime a life insurance policy is going to pay money out to the policy owner, it provides optional ways for that money to be paid. In prior lessons, we talked about the dividend options as one example, non-forfeiture options being another example. Anytime a policy makes money available, it provides several optional ways to receive that money. This is especially important when it comes to the death benefit, or what we call settlement options, which are the optional ways that the death benefit can be paid out to the insured or to the policy owner. It can be paid out as a cash payment, or it could be used to provide periodic income for the life of the beneficiary. There are a variety of ways which are described in the lesson. The key point that I want to drive home here that'll help you understand, I think, the various options is the very basic fact that all settlement options are what we call actuarially equivalent, which simply means that even though it looks like they are different, but it may appear that one is more valuable than the other, the fact is, to the insurance company, they are mathematically or actuarially equivalent. And that's an important thing to understand, because the policy owner needs to know that whatever option you select, there is a cost-benefit analysis, you might say, that's involved in it. If they want the money paid out for the life of the beneficiary, okay, that's an important benefit, but depending on what type of life income option is selected, that monthly payment is going to be higher or lower than another option. So just keep that in mind. When you learn about settlement options, they are all actuarially equivalent from the insurance company. It's just which one is more important to the beneficiary and to the policy owner. That should be the determining criteria, not is one more valuable than the other, because they're all the same.
Okay, so here is the 4 questions for this lesson. For any given life policy death benefit amount, which of the following settlement options generally provide the largest monthly income to the payee? So I'm going to say straight life. I'm just guessing here. I don't know. Which of the following correctly describe the 2 basic categories of life insurance settlement options? I'm going to straight life and survivorship. All the following statements are about in life insurance settlement options are true except I don't think the policy or beneficiary can determine the options. I could be wrong. Under the settlement option that Gary and Fran chose for their father's life insurance, they receive monthly payments until the second payee survivor dies. At that point, the income payment stops. What option did Gary and Fran, choose? Joint and survivor life income. So we got half of these right. The last one we got right, which we just did, which makes sense, joint and life. And the first one we got right, which was straight life income settlement option. They provide the largest monthly income to the payee, straight life. So let's look at the ones we got wrong here. Which of the following describes two basic categories of life insurance settlement options? Those without a life contingency and those with a life contingency is the correct answer. All right, number 3. All of the following are correct except all settlement options include a life contingency. So all settlement options do not include a life contingency. The policy owner could determine the settlement options or let the beneficiary select them. That was not the correct answer. Okay, so this ends this lesson. If you need more assistance on it, just go back and listen to the video again or my other videos on this in this section. The next one we'll talk about is riders for disability protection.